They were the smartest men on Wall Street. Two of them had just won the Nobel Prize in economics. Together they built a machine that, by their own mathematics, could almost never lose money. It was called long-term capital management. And in a few weeks in the autumn of 1998, it lost $4.5 billion, and came within days of dragging the entire global financial system down with it. This is the story of how the greatest collection of financial genius ever assembled built a fortune out of tiny, near-invisible cracks in the world's markets, borrowed more money than almost any institution on earth to do it, and then watched their perfect equations detonate, all at once, the moment the world did something the models said was impossible. It began with one man, John Meriwether. Through the 1980s, at the investment bank Salomon Brothers, Meriwether had built and run the most profitable trading desk in the world, a group of brilliant, secretive traders who made billions exploiting tiny differences in the prices of government bonds. He was quiet, careful, and to the young mathematicians he hired, something close to a god. His traders were not the shouting men of legend. They were physicists and PhDs, recruited from universities, who saw the markets as a vast equation to be solved. Where others gambled on hunches, Meriwether's group measured, modeled, and calculated. For years, it worked so perfectly that the rest of Wall Street simply could not understand where all the money was coming from. Then, in 1991, a trading scandal at Salomon forced Meriwether out. But he had a bigger idea. What if he took his best people, walked away from the bank, and built a private fund, answerable to no one, that would run his strategy on a scale no bank would ever permit? In 1994, he did exactly that. He called it long-term capital management. To run it, Meriwether assembled what the press called the finest financial minds ever gathered in one place. Two of them, Myron Scholes and Robert Merton, had literally invented the mathematics of modern finance, the formula the entire world used to price risk. In 1997, they would win the Nobel Prize for it. Another partner had just been vice chairman of the Federal Reserve itself. Investors did not just trust this fund. They worshipped it. LTCM demanded enormous minimum investments, locked the money in for years, kept its methods a total secret, and still the biggest banks and richest people in the world begged to be let in. It opened its doors with more than $1 billion in capital and a single, intoxicating promise, that genius, at last, had made investing safe. So what did all that genius actually do? Something that sounds almost boring. Somewhere in the world, at any moment, two bonds that should be worth almost exactly the same are trading at slightly different prices, a tiny gap, a few pennies wide, that history says will close. LTCM's machine hunted those gaps, all over the planet, and bet that they would converge. Buy the cheap one, sell the dear one, wait, and collect the difference. It is called convergence arbitrage, and done correctly it is astonishingly safe. You are not betting on markets rising or falling, only on two prices drifting back together, which they almost always do. The problem is the size of the prize. The gaps are so tiny that to make real money, you must bet colossal sums. And that is where the story turns from genius into gunpowder. Here is one of their favorite trades, in plain terms. When the American government issues a brand new bond, it trades at a tiny premium over the almost identical bond issued a few months earlier, purely because the new one is easier to buy and sell. That gap is minuscule, and over time it always closes. LTCM would buy the slightly cheaper old bond, sell the newer one, and wait. Repeat that thousands of times, across dozens of countries, and the pennies quietly became millions. To turn pennies into fortunes, LTCM borrowed. And borrowed. For every dollar its investors had put in, the fund controlled more than $25 of bonds, and once you counted its derivatives, its total exposure passed $1 trillion. Traders had a grim name for this kind of strategy, picking up nickels in front of a steamroller. Bend for enough nickels, fast enough, and the steamroller always seems far away. And the banks made it easy. So desperate were they to do business with the legendary fund that they lent to LTCM on terms they gave no one else, sometimes demanding almost no cushion at all against a bad day. Everyone assumed that a fund this brilliant, this diversified, could never really be in danger. The whole system leaned in toward LTCM, and almost no one stopped to ask what would happen if it fell. Leverage is a magnifying glass. It makes small gains enormous, and small losses fatal. At 25-1, a move of just 4% against you erases everything. LTCM's models insisted that such a move, hitting all its positions at once, was so unlikely it might happen only once in the lifetime of the universe. The partners believed the numbers. So they left the leverage on, and pointed the magnifying glass straight at the sun. For a while, it was a miracle. In its first years, LTCM returned 40%, then 40% again, profits so smooth and so vast that the partners grew fabulously rich and the fund swelled to over $100 billion in positions. Rivals tried frantically to copy its trades. And in 1997, Scholes and Merton flew to Stockholm to collect their Nobel Prize. The machine, it seemed, truly could not lose. By 1998, LTCM was not just a fund, it was a legend. Its offices in Greenwich, Connecticut were a temple of quiet certainty, far from the noise of Wall Street. The partners flew first class, played high-stakes games for sport, and spoke of risk as a problem they had already solved. They believed they had engineered something close to a perpetual motion machine for money. And pride, the oldest character in every one of these stories, had quietly pulled up a chair. There was even a warning that year, and they sailed straight through it. When a financial crisis tore across Asia in 1997, LTCM took some losses, and then recovered, its confidence higher than ever. So sure were the partners that the good times would continue that they did something extraordinary, they handed billions of dollars back to outside investors, to keep more of the coming profits for themselves. They were, quite literally, betting the house. By the summer of 1998, something felt wrong. Markets everywhere had turned jittery and afraid. The tiny gaps LTCM lived on had stopped closing, and a few had begun, very slightly, to widen. The fund started to lose money. Not catastrophically, not yet. But the machine that was built for calm was running, for the first time, into a rising wind. And then, in August, the wind became a hurricane. On the 17th of August, 1998, the impossible happened. Russia, a nuclear power, a national government, simply refused to pay its debts. It defaulted. And across the planet, terrified investors did the one thing LTCM's models assumed they would never all do at once, they ran for safety, together, everywhere, at the same moment. The tiny gaps that were supposed to close began instead to fly violently apart. This was the flaw hidden at the heart of all that genius. The models assumed LTCM's thousands of bets, scattered across the whole world, were largely independent, that they could not possibly all lose on the same day. But in a true panic, that assumption evaporates. Every market lunges toward safety at once. Correlations that were meant to be near zero snapped to 1. A fund built to profit from calm was now hemorrhaging from every position it held, simultaneously. Every clever position turned into a trap at the very same instant. Their bet that the prices of nearly identical shares would drift together, they flew apart. Their bet that the market's panic would fade, it deepened. Their bet on the calm of the world's bond markets, the world was anything but calm. Trades that had no business ever moving together all cratered on the same afternoons, precisely as the mathematics had sworn was impossible. The losses came with terrifying speed. In a single day that August, the fund lost $500 million. Then more. Its capital, nearly $5 billion at the start of the year, began evaporating by hundreds of millions a week. And because it had borrowed so heavily, every drop in value triggered demands from its lenders for more cash the fund no longer had. The steamroller had arrived, and the partners were still bent over, hands full of nickels. Inside LTCM's offices in Greenwich, Connecticut, the smartest men in finance watched their own fortunes vanish alongside their investors. Most of the partners had their own money, their whole net worth, tied up in the fund. Now they worked around the clock, desperate to raise cash, calling every powerful name they knew. The machine that had made investing look effortless was devouring them, and there was nothing in the equations to tell them how to stop it. They reached for saviors. They called the legendary investor Warren Buffett. They called the financier George Soros. And for a moment there was hope. Buffett actually assembled a group and made an offer to buy the fund outright and rescue it. But the bid was tangled in legal knots and a ticking clock, and within hours it fell apart. The richest men in the world had looked at LTCM's books, and most of them backed slowly away. Warren Buffett's offer was almost surreal in its scale, a bid to buy the entire fund, and its $1 trillion of positions, for a small fraction of what they had once been worth. Meriwether was given barely an hour to accept. But the fund's tangled legal structure made a clean sale impossible in the time allowed, the phone line snarled, and the deadline passed. The last private lifeline had slipped through their fingers. Now there was only one institution left to call. Because this was the part that made hardened bankers go pale. LTCM did not owe money to just one lender. It had contracts, loans and derivatives with nearly every major bank on Wall Street and across Europe, over $1 trillion of them. If the fund collapsed and defaulted on all of it at once, the losses would tear through the whole system, bank by bank, in a chain reaction with no obvious end. A single failing hedge fund, run out of a suburban office in Connecticut, had quietly become a loaded gun pointed at the heart of the global economy. The men who ran the Federal Reserve looked at the tangle of exposures and saw something they had never quite seen before, not one company in danger, but the possibility that its fall could take everyone else down with it. And they decided they could not simply let it happen. So the most powerful institution in American finance did something extraordinary. Inside this building, the Federal Reserve Bank of New York, its president summoned the heads of Wall Street's biggest banks into a single room. Not to spend a cent of public money, he insisted, but to solve a problem none of them could survive alone. The rescue of long-term capital management would be arranged, face to face, by the very firms it threatened to destroy. It was a tense and bitter meeting. These were fierce rivals, being asked to hand over billions to save a fund that had lorded its genius over all of them. They argued. They resented it. One firm, Bear Stearns, refused to put in a single dollar. But the alternative, letting LTCM detonate and facing the wreckage together, was worse than swallowing their pride. One by one, the others agreed. For hours, the most powerful bankers in the world sat in that room and stared into the abyss. Every one of them stood to lose a fortune if LTCM failed, and every one of them despised the idea of rescuing the arrogant fund that had beaten them for years. The Fed did not, and could not, order them to pay. It simply made the danger impossible to look away from, and let the men in the room arrive, one reluctant nod at a time, at the only answer that saved them all. On the 23rd of September, 1998, it was done. 14 of the world's largest banks poured in around $3.5 billion, taking over 90% of the fund so its positions could be unwound slowly, quietly, without the fire sale that would have set off the panic. No taxpayer money was spent. But it was the Federal Reserve that had forced Wall Street's rivals into one room and would not let them leave without a deal. The genius partners, worth hundreds of millions each only months before, were all but wiped out. The fund that was going to run forever was wound down over the next 2 years and quietly closed. The Nobel Prize-winning formulas had been right about almost everything, except the single thing that breaks them every time: human fear, and the terrible day when everything falls together, at once. When the accounts were finally settled, the partners had lost almost everything: their fortunes, their reputations, and the myth that had surrounded them. Some had borrowed money to pour even more into their own fund, and walked away in debt. The Nobel laureates went quietly back to their universities. And Wall Street, once the shock had faded, drew exactly the wrong lesson: not that leverage and arrogance were deadly, but that if you simply grew big enough, someone would always be there to catch you. And here is why this story reaches so far beyond one fund. LTCM was the dress rehearsal. It showed the whole world a frightening new truth, that a single, wildly leveraged institution, entangled with everyone else, could threaten the entire system, and that when it did, someone would step in to save it. 10 years later, in 2008, the same script would play out again, 100 times larger, with the words "too big to fail" on every front page. As for John Meriwether, he simply started another fund. And in 2009, that one collapsed too. So here is the question I'll leave you with. Were the smartest men in the world brought down by one freak event in Russia, or was the flaw always there, hidden inside the belief that any equation, however brilliant, can truly tame the markets? Tell me in the comments. And subscribe, because on this channel, the ledger always comes due.